What's going on, Mr. Dale?
Hello, hello. Let me change the
Hello.
background.
Yeah, what do you think of that? I like your background. Oh, there we go.
That's from my backyard.
Oh, very nice. There on Lake Chelan.
Lake Chelan, yep.
Chelan. Okay, I'm not pronouncing it right.
Well, it's the accent.
Yeah. That's great. That is great. You ever do any fishing in there?
I don't, because I'm a very impatient fisherman, but the fishery is open year round. Actually, it's not one of those seasonal ones. It's open all year long, but it gets kind of cold to be out on your boat in the winter.
Oh, yeah. Oh, man. Yeah, definitely. For sure.
Huh?
For sure.
Yeah. When you're gonna get on? Hang on a second, Ken. You're gonna get on? Okay. My son's gonna join us.
Oh, great.
So, yeah, that's why I like being over there. You're looking
Yeah,
right
I
at the
would
town
too.
of you're looking right at the town of Chelan, and when you if you look at the lake, there is it kind of goes up into the northwest, and so it's got several turns. But before it makes that first turn is where our house is on the south shore. So.
Oh, wow. That is great. That is great.
Look up the Bear Mountain golf course at Lake Chelan too. You have to add Lake Chelan because there's several Bear Mountain golf courses like in Montana and other places. But that golf course is the one I told you about too.
Gotcha. How about that? That's tremendous. Yeah. That is tremendous.
So anyway, I put this up and then people go, "Really?" I'm like, yeah, okay.
It's really there.
I'll put up my my no background.
Oh, you can. There you go. Whatever you want.
That's
Whatever
boring,
works.
right?
Absolutely. Well, we'll give it
water
another
view
minute.
over here too on Puget Sound. So if you ever look at Edmonds, we're right on the water in Edmonds too. So.
Excellent. Yeah. It's hard to go wrong with a location like that. It really is.
It is.
Hard to go wrong. Well, we will get going here. Let me share my screen here. Start this deal. And we will get rolling. All right. All right. Well, hey, everybody, I'm glad you could join us for our webinar today. We're going to talk about Captive Insurance 101 and talk about some different industries that have been affected by captive insurance in a positive light. So I'll tell you a little bit about who I am. I'm Ken Huffman. I'm a CPA. And what we do is we create and manage captive insurance companies for business owners. So I'm going to give you a brief summary of what captive insurance is, a kind of a 90-second overview, and then we'll get into more details and go into different examples. So here we go, 90 seconds. Here's what captive insurance is. Okay, you have a business. It's going to create a private insurance company to insure this business. It's going to insure it for things that are either too expensive or are not available traditionally through commercial carriers, okay? So the business is going to write a check for the premiums to its own insurance company. Now, we're not going to hold all the risk here in our insurance company. We're going to reinsure that, all right? So that if something happens, we're not paying dollar for dollar, and we're also accomplishing the required risk distribution. So we're going to reinsure all those. Additionally, this money that is sitting here, it can be invested, typically in Wall Street funds. So you're gaining even more revenue through that. Starting in year 2, you can start taking out qualified dividends, reasonable qualified dividends. So why is it so great? The primary purpose of a captive is to insure the business. So you're getting all this extra coverage that you currently do not have, right? So your business is protected. A lot of business owners and CPAs like the tax advantage of it. So you're doing a deduction on your business for the premiums, but the money that comes over to your captive insurance company, There's an exemption called the 831B exemption. It says you can deduct up to $2.3 million per year in insurance premiums. So it protects the business, it decreases taxes, and it builds the wealth of the business owner. So I think that's about 90 seconds. It may have gone a little bit over, but you know, captives aren't new. It's been going a long time, since 1950s. Most of your Fortune 500 companies have these already in place. We're bringing it to the small to medium-sized business. There's no reason they can't do it themselves. And again, it's a private insurance company that is owned by the business owner. Okay, so it is for risk management purposes. It's a company and not an insurance product. Something to keep in mind for sure. Who's it for? Who does this work for? Well, if you have gross revenue of 2 million to 2 billion, it's something you need to be looking into. Okay, and any type of business can benefit from having a captive. It doesn't matter. And why is that? Every business has risk. Every single one. And so physicians, manufacturers, construction, we'll go through several examples today. But if somebody grosses over 2 million, and I don't mean net income, I'm talking total sales of all their businesses, if it's at least 2 million, it's something to look into. If it's below that, the economics typically don't work out as well for them. So like I said before, it accomplishes 3 things: protect your business, decrease your taxes, and build wealth. This integrates with your traditional commercial insurance. You are not dropping your traditional commercial insurance. It's integrating with it. You're getting access to policies that are typically, again, not available commercially, or if they are, it's too expensive, right? And so it just doesn't make sense. But if you own the insurance company, you don't lose the premiums. You get to keep the premiums. Now it makes sense. So let's look at what does it really cover here. Let's see if I can get my little laser pointer going here. Here we go. Okay, so you have your current commercial insurance, right? Well, then you also have, what about these gaps, exclusions, deductibles, right? You know, you get 1 page of what's covered on your traditional commercial policies and then 300 pages of what's not covered. That is what a captive can cover. Here's kind of an overview. This is a very limited snapshot. There's hundreds of policies that could be covered by a captive. Let's look at a couple. Business interruption insurance. Let's say you have a restaurant and a coffee shop, and they start doing construction on the road right outside your coffee shop. Is that going to affect business? Absolutely it will. People can't get in there. So you'll have lost sales, right? Well, that if you had a captive, you could file a claim and get paid for that difference between your sales of what you typically would have had and what you ended up with. So it pays off in that regard. Commercial gaps and exclusions, as I just mentioned before. There's all kinds of gaps and exclusions, and people are finding that out, aren't they? They are realizing it now. A lot of businesses are realizing, hey, I thought I was covered for coronavirus. They're not, right? So there's a lot of them policies have exclusions for pandemics, such as what we're in right now. So, you know, right now in our history, it's a crazy time, and people are really suffering in a big way. And so this is really showing the value of captive insurance. And so if you have it, you're going to be in a lot better shape than if you do not have it. Because again, it covers those gaps, exclusions, deductible. How about cyber risk? I mean, how many times have you heard on the news somebody else got hit, right? With ransomware, or somebody got into their system and all your credit card stuff's compromised. It happens all the time. And we're talking, look at those numbers. 2019 cost around 11 billion, 2020, 20 billion. It's only going up, right? And so you need some type of policy that's going to cover that in case it happens. Well, you may be thinking, I don't want to pay for that, right? I don't want to pay. But remember, everybody, you're writing a check from your business to an insurance company you own. So you get to keep that premium if you never lose it. Deductible reimbursement. Here's a really big one, okay? And we're going to give an example of this soon. You can increase your traditional commercial deductibles. It will drive down the cost of your premiums. And then you write a deductible reimbursement policy, right? So that if something does happen in your business and you're like, okay, I have to file a claim, you can get the money, you can file a claim, get the money for the deductible from the captive. So it saves you a tremendous amount on your traditional commercial insurance. Employment practice liability, the Me Too movement, sexual harassment, there's all kinds of things that are covered underneath this that, you know, it's better to have coverage than not have coverage. So let's look at this example. Pizza company is one of our clients that had, they transported cheese all over the nation. If one of those trucks, or if several of those trucks broke down, the cheese would spoil. And that causes a problem because you can't make any pizza without the cheese. You with me? I mean, you gotta have it. You gotta have cheese. So it saves the company a tremendous amount. It protects that business. There's a lot of taxes saved involved in it. And you have additional protection. You know, in any business, you have to think, okay, what are my risks here? What am I exposed in? Well, they're covering that exposure through a private insurance company. So additional protection and its competitive advantage. Also, this company wanted to do one of those satisfaction guarantees. We guarantee your pizza is going to be good and arrive in good condition. And so they used it for that as well. Here's another thing that you can use it for: loss of a key client or a contractor. You know, let's say a business has really 3 clients that make up 80% of their revenue. And if they would lose one of those clients, it would hurt them in a big way. You know, maybe they lose $500,000 in revenue. And the people just either, whatever, went out of business or went to a competitor. If you had a captive, you would be able to file a claim and get paid for them leaving. Do you see how that kind of helps your business, how it safeguards it? You know, you build up a financial planning practice or whatever it is, you can safeguard that. Loss of a key employee, another one. Let's say a salesperson brings in, you know, $500,000 per year. If they leave the company, will that hurt? Absolutely. You know, so many business owners have key employees that really run everything. The business owners are kind of checked out. Well, this is a way to ensure that, you know what, your business is going to stay marketable because you're going to eventually sell it. You can ensure that if that key employee leaves, you're going to be okay. And you're going to be able to get paid, file a claim, and get reimbursed for what they would have brought in. Loss of a key supplier. Here's another great one. You know, let's say you produced chairs. And the material that you have on the chairs is expensive, but you've been doing business with this company for 10, 15 years. This supplier, they're half off the competition, right? If they go out of business, you now have to buy from their competitors, which what happens to your profit margin? It goes way down, right? Unless you have a captive. It will cover the cost difference between your old supplier and your new supplier. Is that valuable? Yeah, it's going to be able to keep you at the top of your business. So something definitely to keep in mind. Product warranty insurance, we'll talk about that a little later. Regulatory changes. Okay, so here's an example. You know, what if the people you get your revenue from is an insurance company and they change their policy? We had a client that they provided services to a nursing home. And insurance would pay 20 days a month for their service. Well, they call us up and they're like, hey, I don't know how many policies we're going to be able to write, how much we're going to be putting into the captive this year, because they made a policy change. Now we only get paid 4 days a month, not 20. So that cut down big time on their cash flow, right? We're like, file a claim. That's the whole point of having a captive insurance company, is to cover your business, right? They filed a claim, ended up getting $1.5 million. So that's very important to them. It's very important to have. It's a huge safeguard. And it's for for insurance. So what about rental income replacement? How many people do you know own shopping centers, strip shopping centers? And if one of their tenants bails on them in the middle of their lease, they can get up to 6 months worth of rental income replacement. Is that helpful? Could people use that right now? Businesses are leaving, going out all the time right now. So that could be a huge help to someone that owns commercial property. So again, it protects your business, integrates with traditional commercial insurance. You have access to policies that are not available commercial or too expensive. And you're creating an asset, a corporation that is creditor proof. Big deal. This is a really big point, y'all. You may sell off your business in 5 years, but what doesn't go with the business? The captive insurance company. It's very difficult to penetrate a captive insurance company because it is an insurance company. So it is creditor proof. No matter what happens to your business or somebody goes after your business or you personally, they can't get to the captive insurance company. This is the second thing that captives do is that it does decrease taxes. A lot of business owners and CPAs like this fact. You get to keep more of what you've earned, right? So how does that work? Well, the premiums from your business that you write a check for, and let's just use a $1 million example, okay? Just because it's a round number, you don't have to put $1 million into these things. You can put 100,000, you can put 10 million. It varies, right? Depends on what the actuary says. But let's say it's $1 million, all right? If you don't have a captive, how much are you paying? $400,000, something like that. But if you have a captive, when you write a check for those premiums, you get to deduct that as a business expense because it's insurance. The money goes over to the captive. Again, you have this special exemption for small insurance companies that makes your premium income exempt. So that is very helpful on the tax front. Distributions, let's see here. Okay, well, Journal of Accountancy talks about this. That's kind of for CPAs, this is one of our main publications that we get a lot of information from. It talks about how the business expense is deductible. And then this is a look at a $500,000 example. If you have income of $500,000 and your insurance premiums are $500,000, your taxable income goes to zero on the business front. Then you have on the captive front, the $500,000 is premium income, right? But that's where you get this exemption and your taxable income goes to zero. So it's a nice benefit. Now, let's look at a case study. All right. So lots of times, end of the year, people make some money and they're like, okay, what do I do? What do I do? Well, we had a situation where the CPA suggested they didn't know about captives. All right. So don't be too hard on them. They didn't know about captives. And so this company had $1 million net profit. So the CPA suggested, hey, you need to buy equipment, right? So they bought $700,000 worth of equipment. They didn't really need, but they didn't want to write a huge check to the IRS. So they did the 179 deduction. They didn't really want to do it, but they did it. The next year, this business owner came across a CPA that knew about captives. And so they were able to do a captive insurance company, and they put that $1 million for that year into the captive insurance company through premiums. And now what do they have? They have an asset that appreciates. What's going to happen to that $1 million worth of equipment in 5 years? What's going to happen to it? How much is it going to be worth? 200,000? Whereas the money that's in the captive, what's it going to be worth in 2 years or 5 years? 1.2 million? 1.5. So it just makes sense, right? You get all kind of coverage on that construction company. And in this situation, it saved them a tremendous amount. So people always ask, all right, so I'll put this money in this captive. How in the world do I get it out? Well, I like to describe it as live, quit, or die. Either way, you're a winner. All right, so you can live and you're loving your captive, right? You're protecting your business, decreasing taxes, building wealth, you're loving it. Starting in year 2, you can start taking qualified dividends out. You will pay tax, okay? You're paying a lower tax. You're paying capital gains rates. Okay, whenever you pull the money out, if you pull the money out, you don't have to, you can just keep the money in there. You can quit. Let's say you get 5 years down the road and you're like, you know, either I don't want to do this anymore, or I don't think I have a need for the captive anymore. You shut down the captive. It becomes a regular C Corp. And in that situation, you can then go buy apartment buildings, a hotel. I mean, you can then use that for whatever you want. It's just a regular C Corp because we relinquished the insurance license. Or you can liquidate the captive, all right? And you just pay capital gains rates. So you liquidate the C Corp and pay capital gains rates. Or there's a third option. If you were to die, we hope that's not going to happen. Okay, but if it were to happen, and let's say there was 10 million in the captive, right? And typically you pull that money out, you're going to pay 2,000 capital gains taxes. But if you were to die, all that, you get a stepped up basis in that corporation, saving your heirs $2 million in taxes. So that's not bad, something to keep in mind, but don't go dying on us. We don't want you to do that. Now, the third thing that it does is that it builds wealth. You're turning premiums into profit. This is one of the hardest things for people to get through, is that the premiums, you know, because it typically doesn't happen. I mean, how many times has State Farm ever sent you a check back saying, you know, you never filed a claim this year, so we just wanted to go ahead and give you all your premiums back, right? It never happens. But with a captive, that's exactly what happens. You get to keep the premiums. You retain them. They're investable, and they're reinsured for really cheap. So that's something to keep in mind. You reduce the traditional commercial insurance costs. That's another great benefit of a captive, right? What do I mean by that? Remember I told you you're not dropping your commercial insurance, okay? But you can make adjustments. You can increase the deductible. You can take the first tranche of liability and have the captive insure that. Look at this case study from this construction company. We just adjusted the deductibles on their traditional commercial insurance. It lowered their premiums significantly. Look at what general liability was. It was $649. The new premium was $487. Workers' comp, $1.2 million, lowered it to $500,000. Commercial auto, $455,000, lowered it to $375,000. All the way down. Their old premiums were $2.5 million. Their new ones, $1.5. Did the captive pay off? Yeah, a savings of $951,000. That's more money they can reinvest into their company. So they have more coverage for a much cheaper rate. And so then they put that savings into the captive, and they got to keep it all. Warranty and insurance program. Okay, this is really reason alone to do a captive. Okay, do you know, okay, you bought a TV like at Best Buy, right? What's the last thing they ask you at the cash register? Do you want the warranty, right? That's a captive insurance company. If you have a client or if you have a business, you can put a warranty or insurance on your product or service. You can do the exact same thing. What does this do? It creates a whole new profit line, right? You've already got the product. You've already got the service. If the clients want the warranty or income, let them have it, right? The insurance. All the premium income goes where? Directly into the captive. And up to 2.3 million would be tax exempt. You think that could be helpful? Absolutely, it sure could. This creates a competitive advantage. That's another reason to do that, right? So you created a new profit line, a competitive advantage, more primary sales. Look at this example. So we had a commercial construction or commercial range company, I think they're out of California, come to us and say, hey, you know, the industry standard is a 1-year warranty. Is there a way we could create a 2-year warranty? You know, they said, we don't even want to charge for it. We just want to have it on our product, a 2-year warranty. So we said, sure, you can do that. So they created a 2-year warranty. Guess what happened to their sales? Boom, shot through the roof. Why? These things are not cheap, right? Commercial ranges are not cheap. And so people are thinking, if I'm going to throw down that kind of money for a commercial range, I want to make sure it lasts at least 2 years, not just one. All right. And so there was a huge competitive advantage. Could they have charged for it? Yeah, but they didn't want to. So it's fine. It worked out really well. It increased their primary sales. So this is a really big way to advantage against your competitors. Now, I'm gonna, a lot of people, what's the total cost? What does all this look like? All right. Again, you use a $1 million example. If you don't have a captive, you pay $400,000 in taxes. You're in a net $600,000. If you have a captive, and put $1 million into that, you're getting millions of coverage. Y'all, this is $10 to $30 million worth of insurance coverage. It's not just $1 million of coverage. You do have management and operating expenses. These things every year, we have an independent actuary to look at them. They're going to go through an independent audit every year. There's premium taxes that the state charges. So then there's also reinsurance. There's claims. Every insurance has claims. All right. So there are going to be claims and reinsurance associated with that. But you also get to reinvest that money, right? And so when you do that, maybe you earn $50,000 on that. I think that's a 5% return. So look at the difference, 600,000 versus 980. It makes a big difference, right? 380 difference. You do that over 10 years, you would end up with 6 million versus 12 million. That's a $6 million difference. It's big time. Onshore versus offshore. We only form our captive insurance companies onshore. Okay, we don't go to Puerto Rico, don't go to overseas, only onshore. There's been problems with the management of captives and regulations offshore. So all of our captives are formed right here in the good old USA. How does the process work? The first thing is a feasibility study. We do that for no charge, just to see, does this make sense for you? What kind of policies could you get? Kind of an estimate of the premiums. If you like that and it makes sense and you want to go forward, you go through underwriting. Okay, we use an independent third-party actuary. We do not use a in-house. We think it's important that the actuary be a third-party independent. That's going to give you the exact policies that you could have. It'll tell you how much risk you have, what kind of policies you can get, and the exact premium amounts. If you like that, we then form it. We form the captive insurance company. We set up the corporation, obtain the insurance license. We do all of that, okay? Get the tax ID number. We do all that for you, so the business owner doesn't have to do that at all. We do that. And then there's ongoing management. You have to coordinate with the state insurance department. Make sure the actuaries are done every year, the audit's done every year. There's a lot of things that go into it. We handle all that for the business owner. Formation time is typically 30 days or less. It all depends on how quickly the client can provide us the information. Why choose a captive? It's going to cover all these things that you're typically not getting covered on. Look at all these policies that your business could be covered for. It protects your business. It decreases your taxes. It builds wealth. So that is what a captive insurance company is. There's all kind of case law on it. It's been around for many, many years. We're happy to discuss any of those with you. And if you have a client of mine, if you have any client that grosses over 2 million, let's at least look at it, right? Let's at least look at it to see, does this make sense from a financial standpoint? What kind of coverage could they get? So feel free to email me. You've got my email right down there, or give me a call if you have anybody in mind, or if you're thinking about, or if you have questions regarding, hey, I had a question on the webinar. How does this particular thing work? This is just a high level overview, right? I can talk about 3 hours if you want me to. I'll talk 3 hours on it. But hey, I enjoyed this. This has been good. Okay, we have one question. Hang on just a minute. If you'll hang on just 1 second. Yeah, okay, Dale, that's a great question. How you determine the premiums on the on a business? It's a very good question. We hire an independent actuary that is going to look at that business or the businesses that that owner has. And it's going to say, okay, you have this amount of risk. Your commercial insurance is currently covering this amount, but you're being exposed this amount. And so to cover that exposures would be 15 different policies. And the premium amounts for those policies is this, right? And so then the owner can decide what they want. I want this policy. I don't want this policy. And during this process, we're talking to the business owner. You know, what keeps you up at night? We want to know about their business. What concerns them? And as we find out about their business and find out about what concerns them and their risk, we can then talk to the actuary and make sure that all the risk that they have is going to be covered. You know, one big part is the general liability. It's a policy called differences in condition. That's one of the most popular ones for general liability because, again, it covers those gaps, exclusions, and deductibles. So that's a great question, Dale. You know, how are the premiums determined? And again, the owner will then pick and choose. Some of the policies, they're not all going to be the same as far as cost wise, right? So they'll have to determine, all right, what can I afford this year? What, you know, how much do I want to put in? That'll change every year. That's another. Let's say your business doubled next year. Well, then you're going to be able to put in way more into the captive because you have more risk. So your premiums, the amount of policies will increase, the premiums will increase. Or take the opposite effect, which probably a lot of people have this year, right? Their business went down, right? So that would mean you're not going to be able to write as many policies. Your premiums are going to be lower. So it's just going to vary from year to year. And we look at it every single year. So, all right. Well, guys, this has been good. I've really enjoyed it. I hope you learned something. If you have any questions whatsoever, or if you have a client you're thinking of, I wonder if this would work for them or not, give me a call. We'll talk about it and we can produce an estimate to see what that looks like. All right. I enjoyed this. Check me out again anytime. We'll see y'all later. Bye-bye.